FRK311 Financial Accounting. Today we're going to look at feedback on Assessment 1 of 2019. This video is specifically question 1 to 5. Now this question, you had to start off by calculating the current certain amounts in the current tax calculation. And the first one that was asked was the one that it says here, profit on the sale of an asset. Now if you go back to your tax handouts, you will actually find that these questions come straight from your class examples. Now to calculate the profit on the sale of an asset, this is your accounting profit. Remember, this is a tax calculation. So what you are seeing here is your accounting profit. And this is what you are that is why you want to calculate number A, what was the accounting profit. Now to be able to do that, let's go to another screen. And there you can see that the first calculation, you first had to calculate what is the carrying amount of the asset and what is the current tax base of the asset. So there, from the beginning, when the asset was initially brought into use, until the day that it was sold, there's your table that we've just calculated. So your current carrying amount is this amount here, and your current tax base is that amount there, tax base, as you can see. So after you've calculated that, you can now go and calculate what was the profit made on the machinery. And remember, this is the total profit made on the machinery. So you take what the machinery was sold for, you deduct the carrying amount and the tax base, which you've just calculated above, and then your total accounting profit and total tax profit are those two amounts. Now this isn't where we're going to stop, because you must remember that in this case, this asset was sold for $5,620,000, which is above original cost. And for that reason, you have now made a capital gains, which is accounting-wise this 70,000, that one there, and tax-wise also a capital gain of 70,000. So you must now split the profit that you made here above, profit that you made there, you must now split between your capital gain on the one hand and profit up to original cost on the other hand. And by doing this calculation, you are now calculating the profit or gain, capital gain on this asset. And then you say, okay, but what is the recoupment up to original cost? In other words, what is the accounting profit up to original cost or the recoupment? If you look accounting wise, that there, your accounting profit is $1,420,000, being the previous depreciation that you wrote down or that you accumulated, and the tax base there, you have a recoupment of original cost minus tax base, which gives you a recoupment of previous tax allowances, wear and tear allowances, of 878,750 rands. Now that you've calculated these two amounts, they will be included in A and B, as you can see there. So A is now the amount that we've just calculated as a recoupment or the tax profit up to original cost. Remember, I stated again, this is just a current tax calculation that you are doing. And to calculate your current tax, you first want to find out what your temporary difference is, which is the accounting profit that you made up to original cost, which you must add back. Then, secondly, a recoupment of previous wear and tear allowances, which is taxable. So you've deducted the accounting profit, you've added the wear and tear allowances, and this now gives you the answers to A and B. Let's go there. So your answers to number 1 is that one there, as we've just discussed. And question number 2, part B, was the 878750. Now for question number 3, you had to remember, what did question 3 ask? Question 3 asked you the wear and tear allowance for the current year, which is allowable for tax. There was a depreciation given for the year, and remember, you're now working with 2 assets, the old asset and the new one. Now the depreciation was calculated correctly, but we required you to calculate the wear and tear. And if you go to the other screen, you will see that our wear and tear calculation, that one there, was the one which you've actually calculated there in your original calculation. So that is your wear and tear on the old machine, and then you just have to go and do the same calculation for the new machine. 9,600,000 divided by 10 years, and that depreciation is only for 9 months. So there you get the 720. Add the 2 together, and that gives you number E, 766,250. That will then be your wear and tear allowance, which the receiver will allow you in the current year as a deduction. And then question number 4. Let's go to question number 4. Question number 4 stated calculation number D. Where is number D? There. Capital gains. Now, can you remember what we calculated on the previous slide on capital gains? We calculated that your capital gains, accounting-wise and tax-wise, was 70,000. Now remember, that 70,000 that you've calculated there is included in the 450 before tax. So all that you have to do here in calculation number D is to bring in or take out, in this case, the non-taxable portion. Now we know that of that 70,000, 80% is taxable. So therefore, 20% is not taxable. What is 20% of 70,000? That answer is 14,000. 5,620 minus 5,550 is 70,000. 20% of that is taxable. That's 14,000, and that is why in our tax calculation, number D there will be the 14,000 that you are bringing in to account into this calculation. And then finally, question number 5 was amount E, which was your allowance on credit losses. Now this one was straightforward. Your allowance on credit losses, as the question stated, is 25% on the 30,000. Now 25% of 30,000 is, there's your answer, 7,500. And if you want to just confirm that, there's the calculation. Right, thank you.